Markets only go up? Well, as we know, that is not the case. Although we did go over 170 days without a greater than a 2% drop in the S&P. Now it remains to be a critical period for both investment positioning and year-end planning. Hello, everyone, and thank you for joining us for our fourth quarter market update. I'm Jeff Carbone, Managing Partner with Cornerstone Wealth, and as always, joined by Cliff Hodge, my partner and Chief Investment Officer at Cornerstone. Today, we'll be taking a closer look at how the markets had evolved over the past few months, the key drivers behind the recent performance, and what we believe investors should be preparing for as we head into the year end. Third quarter was marked by a mix of resilience and some uncertainty. We saw an ongoing push-pull on trade as well as with the interest rate expectations. We've seen some cooling in the inflation data and some shifting in market leadership. This was all against a backdrop of global concerns and the U.S. economy that remains relatively strong. Equity markets have shown strength on business spending and AI, while bond markets continue to digest the Fed's path and evolving inflation outlook. Our goal today remains to provide you, all listening, the clarity and confidence, and to provide the context around what's happening in the economy and the financial markets. We'll look to highlight the key trends we're watching and share actionable insights as we move into the final quarter of the year. Let's begin with a brief review of what's driven the markets through the Q3 and what we watch into year end and beyond. Cliff will review in greater detail the economic data and wrap up with some practical takeaways. All right, let's take a look. We've seen the earnings momentum here. It's support in the third quarter. Analysts expect about a 9% year-over-year earnings growth from the S&P. The market seems to have tilted back towards the fundamentals while raising the bar for future performance. Monetary policy remains a tightrope walk. We did get a recent rate drop from the Fed, and future moves will continue to depend on how sticky inflation proves to be. From the recent Federal Markets Committee minutes and the dot plot, it does show potentially another 2 rate drops before year end. Tariff, supply chain pressures, and input costs continue to complicate the inflation dynamics. Businesses are reporting cost pressures, especially with raw materials, logistics, and labor. Who's going to pay for the increases? Valuations, concentration risk, and the historic valuations show it's not cheap at the present time. The Mag 7 are back. Did they really ever go away? That means downside, more dangerous, particularly if sentiment shifts. Slower growth and the consumer remains resilient. The U.S. is not in recession territory, but consumer spending is softening. The labor markets are cooling, but earnings growth and overall healthy job market is helping sustain the demand. Cliff, with all that, let's jump in, starting with a look back at the key economic data, how the markets performed in the third quarter, and look to themes driving investor sentiment today.
Thanks, Jeff. And we'll start, as we always do, with a brief review of what have been driving markets in 2025. But before going into the details, I thought we could have a little fun with a ChatGPT cartoon that the investment team created, which really encapsulates the investor experience for the year, where markets have been climbing a wall of worry. There have been a number of headwinds ranging from geopolitical tensions with China, trade risks and tariffs, sky-high equity market valuations, and a cooling labor market. None of these headwinds have been able to derail this bull market, which have all been underpinned by the AI mega theme, the Federal Reserve embarking on a rate-cutting cycle, and a weaker dollar, which have supported global profits. And that's not to mention the most recent headwind, the government shutdown, which continues to roll on with no signs of reopening at this point. So now we'll get into some of the data. If we look on the left-hand side of the graph there, we'll see that from a GDP growth perspective, the economy continues to be quite resilient, and there are signs of reacceleration. Inflation remains elevated and stubborn at about 2.9% during the most recent reading, quite a ways above the Fed's 2% inflation target. You can also see that the labor markets are cooling as the unemployment rate has ticked up slightly, though not giving any concerning signals at this point. As I mentioned, the Fed has embarked on the rate cutting cycle with a 25 basis point rate cut last year. But surprisingly, earnings growth have been quite resilient and quite strong, up over 12% year over year, and supporting the equity markets. The table on the right looks at valuations and returns for the equity markets, which, as you can see with the S&P 500, is up nearly 15% year to date. But it's not just a Mag 7 story this year. Even though the NASDAQ is performing quite well, we're seeing a broadening out of participation among all different sorts of equity markets. International is leading the way, the Dow Jones is up double digits, and small caps are beginning to participate as well. And this is the kind of action you want to see in a healthy market. We don't like to see those very high levels of concentration like we've seen previously in 2024 and then to a degree in 2023. Bond markets as well are looking solid, with the Barclays Ag up 6% year over year and a 60-40 portfolio invested among equities, international in the U.S. markets, and fixed income up a little bit over 12. And so now we'll get into our key investment themes for 2025 and beyond. As we mentioned, the fundamentals in the stock market and the momentum that we've experienced have been supported by a Goldilocks economy, the AI mega theme, and a dovish Fed. The Fed just recently announced a 25 basis point rate cut with expectations for 2 more in 2025 before continuing to cut into 2026 and potentially 2027. As we'll see, this setup from a Federal Reserve standpoint has been bullish historically for risk assets, especially during periods that are not followed by a recession. Recession risks are anchored, in our opinion, and we don't see any major risk impending on the horizon, while the business cycle does continue to slow, especially around the lower-end consumer and the labor market. The good news is that in 2025, equity markets have been driven by fundamentals and been underpinned by strong earnings growth. And while valuations are a headwind, we're at 25-year highs from price to earnings ratio perspective, as long as companies continue to deliver, we think equity markets can continue to perform, especially into year end. So now we'll look at the dashboard. And there are 3 sections of the dashboard: the fundamentals, macro, and then the behavior or the sentiment indicators that we track. As you can see, more green on the screen than what we've experienced over the last couple of quarters, as the macro backdrop remains very solid and we have a Fed embarking on an easing cycle. We've had high earnings growth, and while expectations are reasonable, we believe they are quite achievable. Really, the only headwinds that we're experiencing currently are those sky-high equity market valuations and a little bit of euphoric sentiment as it relates to the options market and retail investors. The good news on that front is that even if there is some short-term volatility driven by some of this euphoric behavior, institutional investors certainly have room to add, which could be supportive to equity markets if there is a short-term sell-off. Looking under the hood, we get into some more of the specifics around the economy, and whether that be the consumer, business activity, or financial indicators, the good news is that when taken all together, all of these data points indicate an economy that is still in expansion mode. And we've actually seen some improvement at the margins quarter over quarter, especially in areas like ISM new orders, which support manufacturing and services. As we mentioned earlier in the call, we are seeing signs that GDP growth may actually be starting to re-accelerate. What we're looking at on the left-hand side is data from the Federal Reserve Bank of Atlanta, which is the much followed GDP Now forecast. And as you can see, once the Fed started these estimates, which take in recent data and extrapolate out into a short-term forecast, you can see that for the third quarter, we're actually forecasting growth rates of almost 4%. And while GDP growth remains strong, inflation also remains elevated and quite sticky. What we're looking at on the right-hand side of the chart is data from the Federal Reserve Bank of New York. inflation expectations over 1, 3, and 5-year periods all remain quite sticky at 3% or greater. This is a problem for the Fed, whose target is a 2% inflation mandate. And so if we see a reaccelerating economy and stickier inflation combined with a rate cut cycle, while that could be a short-term positive sugar high, over the longer term, that could introduce a policy mistake and be something that the Fed may have to manage. So that is going to be a risk that we're going to be watching quite closely over the coming quarters. So now what we're looking at on the left-hand side is really a breakdown of the major components of GDP growth over the last few years. And as you can see, looking at the yellow bar, we are seeing signs of slowing driven by the consumer, but that is being offset by investment in AI. And as we can see on the right-hand side of the screen, in 2025, even though we're only about 10 months through the year so far, infrastructure spending on AI has accounted for over 1% of GDP growth, which is quite significant and forecast to continue to support the economy from the hyperscalers, names like Meta, Google, Microsoft, Amazon, who have already spent about $400 billion in capital expenditures on AI this year. That's forecast to grow to over $500 billion in AI spending next year. These are big numbers. And while these have been certainly very supportive of the economy and very supportive of the stock market, at some point there is going to have to be a return on investment on all of this AI spending, which as of today is very highly speculative and a hope for the future, which has yet to materialize. We've been thinking and talking a lot about this theme with the broader supports of the economy shifting away from the consumer in the labor markets and more into capital expenditures. As we can see on the left-hand side, that darker blue bar, that darker blue line, shows a very strong acceleration in investment spending on software and equipment that go into data centers, while at the same time, the green line represents labor demand. So all of this spending in the economy on AI infrastructure and data centers has been a positive for the overall economy and positive for the overall markets, but it has not supported the labor market. And as we can see on the right-hand side, we are nearing the first time in history where total construction spending on AI is getting set to outpace total construction spending on office in our economy, which just really underpins this theme of potentially a jobless recovery, where the balance of power is shifting from labor over to capital. So that's the view on the macroeconomy, the Federal Reserve, and AI spending. We're going to get a little bit more granular into what the markets are expecting from a rate cutting cycle and how historically that has been positive for risk assets, especially in scenarios that are not accompanied by a recession. So now we'll get a little bit more into the Fed. We'll look at valuations and answer questions that we've gotten regarding whether or not we are in a bubble. So what we're looking at here is the path of the federal funds rate. And the Fed just recently announced a 25 basis point rate cut, even though, as we've discussed, the underlying economy has been strong, and inflation has been sticky. They've been more focused on the labor market and the weakness that we've seen there with the unemployment rate ticking up and revisions to the actual payroll numbers, which have been strongly negative. As you can see, the yellow line are expectations that are priced into markets now for where the federal funds rate is going to end in 2026. And as you can see, the market is anticipating a much more dovish Fed, especially when Federal Chairman Jerome Powell's term as the current Fed chairman ends in May of 2026. Right now, markets are pricing in another 5 rate cuts from here with a terminal value of 3% by the end of 2026. And when you look historically what that means for a cutting cycle, especially once we are at the point in the cycle where growth has peaked, historically it's been quite bullish over a 2 to 3 year period. especially during times that have not been followed by a recession. And so as we're looking at this chart, there's a couple of key takeaways. The blue shaded area only represents the interquartile range from the 25th percentile to the 75th percentile. So extremes have been cut off. But as you can see on average over different Fed cycle periods going back to the 1950s, on a 2 to 3 year time horizon from when growth peaks and the Fed starts a cutting cycle, markets have been higher. So that is a great setup for where we are currently. The problem today is that valuations are at extreme points. And we'll look at a comparison here momentarily, but over longer periods of time, valuations matter. Over the short and intermediate term, valuations are less important, and they are certainly not a timing tool. As you can see on the left-hand side, with our friends from JP Morgan have created this chart that on a 1 year period where valuations are at the levels at which they are today, we've seen returns range from anywhere from a positive 30% to a negative 30%, and very little explanatory power over a 1 year return period. The chart on the right looks out over the longer term, over a 5 year return period. Every time historically that we've been at these levels, call it 23 times forward earnings, 5 year returns have been quite muted. So while the setup from Federal Reserve activity and from fiscal policy, so we'll talk about the One Big Beautiful Bill Act, which should be supportive for the economy and for markets into 2026. Over the longer term, we think investors should temper their expectations for returns in stocks and look to diversify their portfolio with other assets. So just how high are valuations? If you look on the left-hand side of the graph, we can see the range from the 10th to 20th percentile going back to 2003. So over 20 years of data, and you can see especially on the far left with the US and even the US ex big tech, we are pushing all-time highs. As you can see, looking across the screen, most markets are expensive and almost historically expensive. The good news, however, is when you look on the right-hand side of the graphic, you can see that fundamentals likewise are near all-time highs, especially in the United States. So while markets are expensive, earnings growth and fundamentals supported by, in this case, return on equity, do tend to give credence to the fact that markets, while they may be expensive, they are not yet in bubble territory. And that's a question that we've gotten fairly often from clients who see all of the euphoria around AI and the high levels of concentration that we've gotten in the equity markets. A common question is, are we in the midst of a bubble? We would say that today the answer is not yet. For a couple of reasons. First and foremost, the fundamental picture, as we've already highlighted. But then we looked at dominant stocks today from a valuation perspective versus dominant stocks during past periods, which have been acknowledged as bubbles. So the tech bubble in the .com, the Japanese financial bubble in the late 80s, and the Nifty 50 bubble in the early 70s. We took the leadership of the most dominant stocks in each of those periods, looked at where they are from a market capitalization, price to earnings, and price to sales perspective. And what we found is that, especially today, if you exclude Tesla from the list, while these earnings, these valuations are elevated relative to earnings, they're not anywhere near the same experience that these dominant stocks were at in past levels in history. Today, we're at roughly 27 times forward earnings. Leadership of the .com on average was almost double that at more than 52. Japanese financial bubble was at 67. And even the Nifty 50, which was not as big of a bubble episode as the other two instances, was still traded at a pretty healthy premium compared to where we are today. So for all these reasons, along with the fundamental backdrop and the earnings picture, we think there could potentially be some room to run on the valuation side, but we are really going to be reliant more on the earnings side. What we're looking at here is the forward PE multiple on the S&P going back to that dot-com bubble. And as you can see, we're at periods that are similar to what we experienced at the peak of the market. What this means is that on a go-forward basis, the returns that we can get from an increase in the valuation multiple are likely going to be constrained, if not even a significant headwind. So that leaves earnings. We're going to continue to need to see solid earnings growth. But fortunately, that is what is being priced into the markets currently. If we look on the right-hand side, we can see expectations both for the Magnificent Seven technology stocks in the dark blue bars and the other 493 companies in the S&P 500 in the green bars. And as you can see, the growth rate projections for the Magnificent Seven are still a pretty significant part of the overall market, but they do not seem unreasonable by any means, with current estimates for about 15% for the Magnificent Seven compared to last quarter when they earned about 28% on average as a cohort. What is encouraging is that you can see those green bars after troughing out in the fourth quarter really starting to pick up into 2026. And so in our opinion, that is really what we're going to need to see for the equity markets to continue to have this continued momentum, is a broadening out of the fundamental results and not just reliant on the Magnificent Seven. We think that the Federal Reserve rate cuts are going to be helpful, and then the stimulus from the One Big Beautiful Bill Act that is set to really take hold in markets in 2026 could be the next drivers of the next leg up in equity markets. So that's the story as we think about the Federal Reserve, we think about valuations and the question as to whether or not we are in a bubble. We've largely focused on the positive drivers for markets. Next, we'll turn our attention toward key risks into year-end and into 2026. We focus largely on positive developments, but now let's turn and look at key risks for investors into year-end and beyond. Into year-end, mainly what we're watching are risks along the political and geopolitical spectrum. On the political front, the major risks for markets relate to the legality of tariffs. These arguments are going to be heard by the Supreme Court next month. If anything, a negative ruling is likely a short-term phenomenon, as even if the tariffs get struck down, there are other avenues that the administration can use to implement them again. On the geopolitical front, risks around China are the wild card. 2 Fridays ago, we saw some announcements around additional tariffs that sent the market down sharply in the afternoon, only to have the threats walked back over the weekend. These could flare up again at any time and at any moment. What we've seen, though, however, time and time again, is that the administration is sensitive to the market reaction. So any volatility could cause an about-face on more aggressive tactics. Longer term, that's where the macro risks come in. We aren't getting any official stats until the government reopens. But the main risk is all about the jobs market. A spike in jobless claims or a meaningful uptick in the unemployment rate would be bearish and would cause us to want to reevaluate the risk stance that we're taking in portfolios. Over the longer term, that's where we're going to focus on AI. We mentioned earlier how much capital investment is going into data centers and AI infrastructure. $400 billion this year and upwards of $500 billion next year. At some point, there is going to have to be a return on this massive investment. As of today, the entire AI ecosystem outside of the Mag 7 is set to produce revenues of only about 20 to 25 billion, half of which is OpenAI. Yet that hasn't stopped them from committing to hundreds of billions of dollars in financing deals. Where does this new money come from? We're also starting to see vendor financing, which echoes some of what we saw during the dot-com bubble, where the chip makers are subsidizing and investing in their own customer base. For now, the markets don't care. But at some point, if the profits don't materialize, sentiment will sour and the hype cycle could deflate pretty rapidly. Again, this is not something that is a concern for us today. This is more of something that could be hitting our radars in 2026 or 2027, in our opinion. So now we'll summarize our key takeaways. As we've discussed, what we've seen so far in 2025 is a resilient economy that has been underpinned by pretty significant AI spending that's driven markets to new highs and to new high valuations. From here, earnings are going to have to do the heavy lifting. The markets are supported by an easing Federal Reserve rate cutting cycle, but the labor market continues to be a key risk. As we mentioned with those high valuations, longer term returns are likely going to be muted. And now, today, diversification is more important than it has ever been in recent history. Getting a little bit more granular on some ideas for diversification, let's take a look at our asset allocation dashboard. And as you can see, some of our more high conviction areas outside of equities are things like private credit and private real estate income, assets that are producing very high levels of income and low levels of volatility can be diversifiers and stabilize a portfolio. Diversifiers are another area where we think investors should be concentrating their bets in their portfolios. Absolute return strategies, real estate, and infrastructure can also provide solid returns and that diversification benefit, which we think is going to be extremely important. So with that, we will wrap up our fourth quarter market webinar. I'll send it back to Jeff, and thank you for your time.
Cliff, thanks for sharing today. Lots of great information. Here's a breakdown of the One Big Beautiful Bill Act of OBBA of 2025, sometimes called the One Big Beautiful Bill, with key highlights and major changes and potential impacts for you, our clients. So what is OBBBA? Formal name and status is H.R. 1 in the 119th Congress. It was signed into law on July 4th of 2025 as a public law. Purpose, it's a massive reconciliation package combining tax policy, changes, spending, adjustments, entitlements, reforms, and regulatory provisions. In political context, it's a bundle of many priorities of President Trump's second-term agenda and passed narrowly in both chambers in the Senate at a 51-50. A tie was broken by the VP, and the House had the amendment at 218 to 214 votes. So some key provisions. They're among the most consequential parts of the OBB, especially for businesses, high net worth individuals, and the structure of the tax code. Some key changes are in the individual rates. The 2017 tax rates were made permanent, with the top tax bracket remaining at 37%. The standard deduction did raise to about $32,200 for the jointly filers, $16,100 for single filers, and head of household $24,150. The SALT deductions changed, with a cap lifted to $40,000 for incomes under $500,000, but that only goes through 2029. For the qualified business deduction, there's a 20% deduction made that was permanent. Bonus depreciation, 100% expensing permanently extended through the Section 179, with the limit increased to $2.5 million, and that will be indexed for inflation. Estate and gift tax, well, we've doubled the exclusion made permanent to over $26 million per couple in 2025. Corporate and international tax adjusted, and basically these lowered some effective tax rates. Charitable deductions have been extended with $1,000 for single and $2,000 for joint filers, even if you're not filing itemized deductions. So lots to discuss with your advisor with the current tax laws before year end. Thank you all for listening. Your trust and confidence is greatly appreciated. Please feel free to share with family, friends, and colleagues. On behalf of the Cornerstone team, we wish you a happy holidays, and we hope to see you all soon.